Splendid evening it is to you viewers. Welcome to Equity News on Equity Access, your aerial perspective of stock market developments and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from Hapton Studios in Harare. I'm Ibn Mabunda. Let's get to business. President Edie Mnangagwa says the new currency will bring economic normalcy. This he said following Treasury as well as RBZ's issuance of statutory instrument 142, which eliminates and deals away with the multi-currency regime which had been in operation for the past 10 years. Effectively, the Zimbabwean dollar has been reintroduced. He also made a tweet to the effect that it is important that Zimbabwe has its own currency in order to achieve economic progress. Let's just have a quick look at the tweet to have an understanding of what the president said in that particular tweet. Let's just have a quick look at it. Okay, essentially he said that there is need that Zimbabwe has an understanding of what's actually taking place in light of the changes within the economy, and that it is imperative and necessary to push Zimbabwe forward through the introduction of that currency. He also made a video statement during the course of the day. Let's have a look.
Imaginative and think for us as to where we might go. With regard to what I said, it was indicative of what was coming, and that which I had indicated has now come. That is, Zimbabwe has gone back to normalcy, and the normalcy is a country must have its own currency. That's normalcy. We were living in an abnormal situation, and you should be the first to congratulate us for becoming normal again. As regarding the second aspect of your question about, you said the national currency, what we have removed with the basket of currency, we have removed them. And our current currency is denominated either by the coins, the bond note, or the RTG. All that is domestic. It's still allowed to do national transactions in the economy. But we have not banned the possession of any other currency, except you cannot transact in any shop. If you want to buy your tea and your American dollar or your euro, Bloomberg or American dollar, then you must go to change. You change there and imaginative and think for us as to where we might go. With regard to what I said, it was indicative of what was coming, and that which I had indicated has now come. That is, Zimbabwe has gone back to normalcy. And the normalcy is a country must have its own currency. That's normalcy. We were living in an abnormal situation, and you should be the first to congratulate us for becoming normal again. As regarding the second aspect of your question, about, you said the national currency. What we have removed with the basket of currency, we have removed them. And our current currency is denominated either by the coins, the bond note, or the RTG. All that is domestic. It's still allowed to do national transactions in the economy. But we have not banned the possession of any other currency, except you cannot transact in any shop. If you want to buy your tea and your American dollar or your euro, Bloomberg or American dollar, then you must go to change. You change there and imaginative and think for us as to where we might go.
Again, let's get into the tweet to look at the key statements highlighted there, to the effect that, okay, just a glitch there. All right, beautiful. Okay, to get, of course, into the tweet, which seems to be quite problematic at this point. Meanwhile, the main opposition party in a press statement has expressed a lack of confidence in government's economic reforms. Let's have a look.
South Africa. So in terms of money supply, the economy can be awash with rands. And we can price all products in rands. Unlike the US dollar, whose supply is inelastic, or is elastic rather, the rand is there finally. So we can reduce the rand while waiting for the right time to join the rand monetary area. That way we can be able to stabilize the economy and deal with our current issues whilst we address the fundamental prerequisites for the introduction of a domestic currency.
Meanwhile, the president of the Confederation of Zimbabwean Retailers, Mr. Denford Mutashu, has urged government to work toward policy consistency if at all the private sector is to have confidence in government policy. He also warned private sector against artificial shortages in light of the currency changes and urged private sector to embrace the local currency as legal tender. This he said in a press statement issued through their site earlier in the day. Listed plastics manufacturer ProPlastics has expressed that the entity will focus more on its export markets in light of the apparent macroeconomic turbulence. This was said by the Chief Executive Officer Kuda Chigia at the sidelines of an annual general meeting held in the capital this morning. He also mentioned that the new plant is ready and will be occupied come the 1st of July. He also expressed that this facility will enhance the operations of the entity. Let's have a look.
Fairly well. We have been affected since October last year due to some certain policy pronouncements. Demand remained subdued, but the encouraging thing is with respect to the US dollar, we are on budget and we improved 60% compared to prior year. In terms of RTGS, I think the numbers now, because of the inflationary pressures, they are actually way above last year. So the business remains profitable, the business remains sustainable going into the future.
I realize.
Yeah.
Now to talk about your plant, what is the update with regards to the plant given what is just played out in the economic setup?
Yeah, the US $5 million plant now sitting on 5,200 square meters is now complete. We're doing the final interior touches to do with your electricals, your lighting and your ablution facilities. We're looking to occupy it beginning the 1st of July, and we're going to fully migrate new and old equipment into the factory in between August and September this year. Full production we're going to begin in October.
I realize.
Yes.
Now, what is the strategy given the announcements by the Reserve Bank of Zimbabwe?
At the moment, we're going to leverage on a lower production RTGS cost. Because the US dollar cost structure in terms of our production was the highest in the region. So the RTGS cost of production is going to be lower, and that is going to stimulate our exports competitiveness in the region.
Okay.
Yeah.
And what is your prospects with regards to the export business?
The prospects are very high. We were in DRC last week. We are in Botswana the coming week. We have always been in Zambia growing the fruit, and the wheel is beginning to turn. It's not easy. But we've been making some penetrative strategy into those territories, and we've got imminent orders that are supposed to be confirmed, sitting on about $500,000. Performed fairly well.
Now to have a look at the historical performance of the entity over the past few years, right from full year of 2014 to full year of 2018. The revenue there has been quite steady at about $14 million US. Meanwhile, the profit after tax has actually been on an upward trajectory from 700,000 in 2015, the same figure in 2016, moving right up to $1.4 million in 2017, and then of course in 2018 more than doubling that at $3.5 million. Then of course a revenue of 24.1, which was a significant jump from $16 million reported in the full year of 2017. This concludes our evening news bulletin. Up next is a look at the news under News Review. Don't go anywhere. Welcome back, viewers. It's now time for news review, and to join me for discussion on the news that we just reported is economist Tinashe Kaduo. Tinashe, good evening and welcome to the show.
Thank you, Eben. Good evening.
Fantastic. Let's get the ball rolling. First and foremost, President of the Confederation of Zimbabwean Retailers, two things. First of all, he warns government against policy inconsistency. Second, he speaks to retailers and says, hey, we cannot afford to have any blackouts in terms of supplies in the shops. We've got to make sure that we continue to supply all our products in the local currency. What is your assessment of that?
You know, it's positive, especially to the economy and to viewers out there. When you know your consortium of retailers is actually being or feeling encouraged, by these, the current shocks that is, it just happened. They send some certain positive signals out there. But I would also want to stress that whenever there is a policy change, it comes with a bit of panic, and when you are in business, sometimes you don't even know how to respond to that policy shock. And if you look at how it was implemented by the government and the way it was communicated, there is a lot of things that are not desirable, which I think the government could have done a bit better in trying to clarify the policy position and to send a certain message to the market. You look at most shops. I did a survey today. People, they are a bit confused. Everyone is still pricing in terms of US dollar as well as local currency. Yes, we are still seeing those dual prices, despite that our policy implementation with immediate effect, if I may quote. But what the government needs to do is to improve in terms of its policy planning as well as the implementation. Sometimes most of the policies that the government implement, they sound like they are more ad hoc. It sounds like the government doesn't have done proper research and analysis, and even looking at the long-term effect of that policy. So consistency is key, which I think the Retailers Association of Zimbabwe should continue pushing that to the government. But for us to have policy consistency, it comes together with a proper planning as well as the way you implement your policies.
But does it not seem like it has been a clear path in terms of what the minister said as soon as he stepped into office last October? He explained how it would be important to first of all achieve fiscal consolidation, bring the foundations back in shape, then from there move toward currency reformations. Is that not exactly what we're actually seeing play out?
You know what, Iban, when we talk of fiscal consolidation, it's something that's that's debatable. Yes, the government is saying that it has managed to record a surplus for the first time in a long period of time. But if you look how that surplus was achieved, there is a lot of things that are not desirable there. You look at what's happening in the economy. We're not paying electricity offshore. That's why we are experiencing these blackouts in terms of our power supply. That's something that we think the government should have addressed first. Our problem is not to do much with currency. There are a lot of things that needs to be done. Our institutions need to be reformed. There's a lot of policy that needs to be channeled out or even reversed and implement some stronger and better policies before we had introduced a local currency.
I realize now President says the new currency will bring economic normalcy. What is your comment and your assessment of what he just said, if we just maybe to zero in on the key statements that he actually made mention of, particularly this statement here that says government and the RBZ are making the necessary steps to ensure this move is a success through increasing the flow of forex into the interbank market while also making forex available to individuals and small businesses through the bureaus. What would be your comment of that statement in question there?
First of all, I think the president is right in terms of identifying that we need a bit of a certain currency that will cater for domestic transactions. What we have been seeing, transpiring in the economy is that the demand, for foreign currency has been too much, coming from one, your domestic transactions, then as well as pressures from your foreign payments. So if maybe we have a certain currency that will take care of your domestic transactions, maybe that will reduce the demand of foreign currency. But to me, what's shocking is that if you look at what has been our thrust in terms of both the government and the central bank, we were driving our economy towards being more of a cashless economy, where we'll be relying much on your card and on your electronic transactions. So in such an environment, and if you look at how the market had accepted or adopted the cashless monetary system, we had actually adopted it and accepted it. So if you look at it, for you to introduce now a paper currency there, you are more like trying to drive us backwards to the situation that we had matured from. So that's where I'm thinking that in terms of the planning process, the government sometimes needs to take its time and maybe have proper policy formulation and maybe do a bit of research and see how it goes.
Okay, but in terms of the implementation of this move, I don't see it as something that was haphazard. Look at some of the details in Structural Instrument 142. One, government is mopping up that $1.2 billion legacy debt that was in the central banks, that was in the local banks as well. You also notice that there's been an upward revision in terms of the interest rates on 15% to 50%. You also see a lot of other measures, including the removal of caps from the interbank market system, as well as administrative limits where the bureaus are concerned. Could we call that something that is actually a makeshift or?
But maybe. For me, I would say it's the RBZ statement later during the day that actually clarified some of the issues. But if you look at if you had been following especially the social media and seeing the statements from the authorities in government, I would quote for an example the Deputy Minister of Information and Publicity. He spoke something. Then also the finance minister said actually that we didn't expect for us to introduce a local currency this fast, but the situation on the ground. To me, this is the finance minister who is in charge of that policy and is accepting that, yes, we have a bit right. So that's why I'm saying that maybe it was more of a reactionary move of what was transpiring on the ground. That's why I'm saying there is a lot that needs to be done in terms of policy implementation, as well as how we communicate a certain key policy if you are government.
I realize. Now let's get into Pro Plastics. They, of course, had an AGM during the course of the day, and I had a close up with the chief executive Kuda, who says, "Look, we are getting into the export business. We have got a deal worth $500,000 that's on the table." And he says, "Look, we're looking to expand where that is concerned." This, of course, would be the historical performance dating back to the full year of 2014. What is your assessment of such developments, especially with the fact that they're looking to open their new plant in January? In July, sorry.
If you look at most of the companies that are actually operating in this economy, most of them, they were trying to diversify into the export market. Why? Because there wasn't much, foreign currency circulating in this economy. So some of these companies like Pro Plastics, which has a foreign currency, component in terms of its production processes, it actually, needs a bit of foreign currency for it to operate smoothly. So I think diversifying into an export market, and we're saying they've got a $500 million deal. I think that's $500,000 deal. Yes. That's something positive. But also, if you look at its historical performance, Pro Plastic it's a solid business and has been performing quite well from 0.1 million there in terms of profits. Then last year 3.5 million. That's quite impressive, and I think even their plant that they are planning to commission They said in 2 weeks. I don't know.
Yes.
In 2 weeks.
First of July, they should be ready for everything.
I think it's something that is quite positive for the company.
I realize. Well, thank you, Tinashe, for the perspectives. Thank you, viewers, for staying with us. Up next is a look at the stock markets in Markets Daily. Please stay tuned.
Welcome back to Markets Daily on Equity Access. My name is Anis Chumbumu, and joining me today is Respect Gwenzi, our chief analyst. We're just going to have a look and a quick dive into the markets today. Before we do, Respect, how are you doing?
I'm doing just good, and you?
I'm very fine, thank you. Well, the market seems, it looks like I got the wrong chart today, but the market is down today, coming off about 0.59% on the all-share index. The industrials index is also down about 5.56%, but the top 10 index is down 0.94% today. Consequent to moves on the Econet counter that did come off about 1.7%, while Delta also conceded a loss there for it to be about 0.3% down on a week-to-date basis, also month-to-date. And then we also have a downward trajectory on our Padinga counter there, pretty much discounting most of the mid-tier gains that we experienced today, where we had about 13 risers on the stock exchange, most of which were mid-tier counters, and then about 5 or 6 of the 9 laggards today were from the top 10 index there. What do you think would be the movement of the stock market going forward? I do understand people may be a little bit confused and really are trying to look at how they can move forward with their investments going forward. Some may begin to sell, some may continue to hold until they have a better understanding as to what's happening. Today seemed as if there was a little bit of panic selling there. What's your take?
But I think when you look at it from a broader view in terms of the value that has been traded, we're coming off the previous session, which really shows that there is panic, but it's still quite limited. I wouldn't say that the market has really gone into panic mode. Yesterday we're up by about 4.5% for the broader market, and over the past 8 days we have actually been rising. So this is still the initial phase, and this is just a reaction to the shock, the monetary shock. But then the initial sentiment is that the market might crash in the coming days. But my own view is that there's still need for caution. The investors will possibly try to digest it before we can really see a crash in the market. If you look at Econet, it's down today, but just 1% in terms of its decline. But when you look at yesterday, it was up by almost 7 to 9%, and that really shows you that there is still not that much big of an impact to the market in terms of the announcements that were made yesterday in terms of the monetary policy. So I believe that we are yet to really see the impact of the monetary changes or the changes in the monetary policy to the stock market. But there's a general view that if the exchange rate comes down, then the stock market might crash, because much of the gains were premised on hedge seeking against a weaker currency.
All right, just as we go into a small break, weekly trends did come off to about 5.9% on the all-share index, 5.7% on the industrials index, while the top 10 index is down 5.6%, is actually up 5.6%. Those were all trimmed down from about 7% in the prior session. Just a quick break. Welcome back, viewers. Now, just a quick look on to our rises and fallers for the day. Star Africa did lead the pack in terms of laggards, coming off a huge 8% there, while Econet, Inscore, Simbisa, and Delta, which are all pretty much top 10 counters, except for Simbisa that got knocked out by Cassava, coming off at an average of about 1.8% thereabout. But Kafka did lead about 13 bulls today, coming up 13.64% to settle at 128.25 cents. I think it's a solid counter, good business. FML did add 11.11% to 20 cents on Deribod, and ZHL trailed and capped that set of top 5 risers, coming up 9, 7.4 and 6.79% in that respective order. What are your takes on some of these counters here?
I think broadly, people are still there's still appetite for stocks, although there's a shock which we really saw through the decline that rose in top tier counters. But broadly, there's still some who believe that there might be some adverse effects to the current policies that were announced yesterday. So there's still that uncertainty from an investor perspective, but the decline in heavies show that on the overall, people who hold real money in the market are of the view that the exchange rate might fall in the coming days from a perspective of the parallel exchange rate.
Okay, quickly, as we just look at the much debatable subject right now, where we have the interbank rate having strengthened by nearly 0%, coming off from 6.32 in the prior session to 6.31 today. The bid price did come off as well as the ask price, selling at 6.31 today, but the parallel market has somewhat remained a little bit firm. Some would suggest that most of the traders on that market already have had a good run of profits for the past 3 months, so they wouldn't panic as much as other markets would try and shift their prices. Only maybe later in the week or maybe early next week could we see that rate coming off because of the $1.3 billion buyback that was done by the government. Old Mutual implied rate settled at 11.4 today.
Yeah, it's still worrying to see that the rate is still at 6.31 on the interbank, but it also shows the technicalities that are involved in trying to liberalize the exchange rate. I think it might take a day or two, but banks were advised as of yesterday to fully liberalize that market and remove all caps. But I think as well, investors or people who are holding real money would also want to give themselves time to have an appreciation of the implication of the policy measures. So I think, in all fairness, it might take a few days for the market to really start to respond in terms of in the positive way. Because just imagine that you're holding your US dollars, you are possibly one of those big exporters, and then there's just that sudden policy shift. You definitely have to digest it first before you seed your money on the market, because by implication, if you seed your money right away and the exchange rate just goes in a different direction, it means you end up losing. Or if you don't take bets when the market is actually firming as well, there might be implications to that. So I think the market is still digesting the recent monetary policy changes, and in the coming days we might really see that rate adjusting. I think on the Beru change, there was definitely some movements. Caps were removed easily and trades were happening at rates are above 12 thereabout.
Okay, so right here we have a representation of an implied rate that is the implied rate coming off from transitory deposits of the bond notes and RTGS money versus our Nostro figures there, which only then started coming up September of 2018 and have pretty much plateaued since March of 19 up until now. Now the implied rate at the current moment is at about 4.5. Should you see the interbank rate coming down to that level?
I think the implied rate is a function of two things. From this chart, it's showing what transferable deposits, which are simply balances bank balances that are held by the RBZ. So banks hold money on behalf of clients, and these deposits are held by the RBZ on behalf of the transacting public. So the total amount is about $3.something billion, and it is juxtaposed against Nostro balances, which are now sitting at above 700 million. And so when you do a simple maths against those two figures, it would give you an implied rate of close to 9 thereabout. But then when you further deduce the function of when you less the 1.2 billion which government is now withdrawing from the system, it reduces the rate down to about 3.5 thereabout. Okay. But then how do we come up with the 4.5? There's a pure risk in terms of trading a local currency. I mean, in terms of holding local money, the country risk, the political risk, and the confidence risk, which actually puts a premium on our currency. But in all fairness, that premium could be anything around 20 to 25%. So if you put a premium of about 25% on an exchange rate of 3.5, you would end up at 4.5. So this is the implied rate when you are using money supply measures, that is in terms of transferable deposits and Nostro deposits. So if you are to convert every other single dollar in the market, and you push it, every other single dollar in terms of deposits, and you push it against Nostros, you would get an implied exchange rate of about 4.5 times. So to then deduce to say, will the market come to that level? I think it's mainly a function of confidence. Obviously, that's the missing link in the market. Government will have to try hard to try to push that agenda, and also for us to sustain the good run in terms of Nostros, it means we have to keep on generating export money. And in the first few months of the year, the trend has not been good, especially in gold and tobacco, which are the key export products. But when you look at the import side, we've managed to constrain our import bill. Of course, some of it is non-payment of electricity and fuel as well, huge queues, no power. But such is the price of taking a move to constrain your imports or the use of real dollars in the market. Getting the rate to those levels, I think, will be far-fetched. But I believe that a rate above 10 is definitely not sustainable.
Okay, so you would suggest a rate that comes down as low as maybe probably 9.
I think even 6 is on the top end.
Okay.
So I think the rate has to be below 10 and maybe close to 6 or even 4.5 thereabout. I mean, using the measure that we've just implied from these numbers. But I think sustaining the rate is the issue, because my worry with government here is that when we get to the year end, we might start to see more pressure coming from the fiscal side. Why? Because we are going to accumulate more debt in the second half. We'll soon run out of the surplus, and we're going to borrow. What is going to be the impact of borrowing at these huge rates in this market? And if you are to dodge the function of borrowing at a higher rate, then it means you have to print money. And when you print money, people have got more to spend, and it might actually induce further inflation, and that has the capacity to kill the productive capacity of the economy. So I think government has to put in measures that ensure that at least the fiscus is sustainably sorted out in terms of consolidating our books, and not just our books, but the real underlying factors such as restructuring of state-owned enterprises, civil service, and so forth, and even issues to do with corruption. If you don't attack those, then you cannot anticipate that the exchange rate can be on a sustainable path downwards.
So in the short term, the currency only has just about a few months or weeks to actually strengthen. And
I believe
and
in the
then-
very, very short term that we might see an immediate shock, especially on the interbank. We might realize an exchange rate of even up to 10 times, but it has to come down. It has to come down within a matter of a week or two to reflect the real demand. Because out of that 3 billion that we are saying is in terms of transferable deposits, it's only about 40% which demands forex. Because if you assume that it's all due to companies, companies have got a 60-40 split between what they demand for their inputs in terms of local and foreign component. So if you are using a crude figure to say we only demand 40% of our inputs in forex, then it reduces even the pressure that should be going towards fetching real dollars on the market. So that would imply a lower, indeed a lower rate.
Okay. Short term, we may have to enjoy a stronger currency, but if Ntuli doesn't fix or consolidate his fiscus, then we are doomed. From the Equity Access team and I, please don't forget to like, follow, subscribe our YouTube, Twitter, Facebook accounts at Equity Access, and do visit our website www.equityaccess.net. Good evening.